Hello, I'm Barrett Hasseldine, and welcome to our video where we'll be discussing what is adverse selection and how it drives poor business outcomes. So I'm head of modeling here at Illion, and part of my job is to keep an eye on the data that we have as a credit bureau to be able to see signs of hidden risk in the market that we can then support credit providers, government, and the media to be able to understand what's going on in the economy. So I'm joined today by Carolyn Romm, who's author of It's a Risky Business. We'll be discussing some of her insights into the importance of what we call adverse selection and why it is very important for credit providers to be aware of it at the point of credit application. Now, adverse selection is not always easy to spot, and so in this video, we'll be talking about what it is and why it can drive unexpected losses in your credit portfolio. So Carolyn, in a nutshell, what is adverse selection and why should we care?
Basically, at a high level, when we talk about adverse selection, what we mean is that as a lender, we think we're taking on board a specific level of risk. However, due to factors that we may not be aware of and can't easily see, we're actually taking on board a lot more risk than we thought we were. And that, in a nutshell, is exactly what it is, taking on board higher risk than we had expected or anticipated.
Right. Now, can you give me some different scenarios of how customer circumstances might not always be completely known to the lender?
The lender can only see the kind of information that's available to them, and that typically comes in the form of information through the application form and information they may glean from external providers like the credit bureau. From a customer point of view, I talk about three different types of customers. The first one would be a customer who may be quite naive, or maybe just really likes the brand that they're shopping with. So they're not really looking around for credit. What they do is they like the customer experience, and they enjoy the credit provider, and they go to one provider and they accept your terms should they be approved. The second type of credit provider is more credit savvy. They understand that different credit providers are likely to offer different terms and conditions. So they may apply to several different providers, wait for letters of acceptance to come back, and then pick or choose the one that they feel best suits their needs and circumstances. Oftentimes they'll be picked based on pricing. The third type of credit provider that we look at looks really similar to the second one. They also apply to a number of different credit providers. The key difference is they're not sure that they're actually going to be accepted. They're not sure that their credit application will be approved. So what they're doing is they're shopping around looking for anyone who will say yes. This means that they're likely to put up with a difficult process, lots of repeated requests for information, higher interest rates, and provided the credit provider says, yes, we're prepared to give you this loan or provide you this credit, they'll take that up.
If we were to try and look under the hood, how can we better understand which of those consumers actually is going to make their credit repayments?
Normally, in the process of assessing risk, credit providers will have an idea of a medium risk customer, perhaps of 100 applications that are deemed medium risk, however they define that. 80 of them will make their payment and maybe 20 will struggle to make all their payments. And they might go, right, based on this, these are the terms and conditions we offer. Now, the trouble is they don't know which of those 80 are going to make those payments. If they did, they'd only approve those 80. So what you have is you have a credit provider saying yes to 100 applicants, and then those applicants have to say, yes, I agree with your terms and conditions, I will accept the credit. And what adverse selection means is instead of all 100 saying yes, or the ratio of those who will pay and those who won't pay coming in at the same ratios as expected, what you see is maybe 20 of those really good paying customers choose to go somewhere else because the pricing is better, because the experience is better. It doesn't really make much of a difference. But what that now means is that instead of having 80 customers who are likely to pay on time, you only have 60 customers who are likely to pay on time. So instead of having odds of 4-1, people who pay versus people who struggle, you now have odds of 3-1. Only 3 customers who are paying for everyone who struggles to pay. And that is the impact of adverse selection.
That reminds me of an example of adverse selection that I was analysing back when comprehensive credit reporting was first released.